In this short video, we will discuss risk reserves. We will first define reserves and then discuss the different type of reserves that are prudent to employ when trading the capital markets. We will then move on to discussing how to implement a reserve and how those reserves should be used when managing a portfolio. The capital markets can be volatile, which can lead to losses in derivative products that are large and difficult to manage. This phenomenon continues to occur today in different scales at large institutions as well as hedge funds. This issue is relevant to the extent that JP Morgan Chase recently reported a loss of greater than $2 billion on very large derivative positions in which the firm needed to unwind the position slowly because liquidity in that position was not to the extent that they could exit at one time. One tool an institution or hedge fund can use to mitigate losses related to liquidity from large trading positions is to install a market risk reserve, which can be used to offset those type of slippage losses. The concept is based on the idea that it is very hard to exit a large position when the market is moving against you. Large positions within the over-the-counter market can have a large standard deviation of returns. The bid-offer spread can also be wide and make it difficult to exit during an adverse move. A market risk reserve is a pool of capital that is set aside when a position is taken in any market. One calculation that can be used to create a market risk reserve is to examine and analyze the historical bid-offer spread on each product that is going to be traded during times of stress as well as times of consolidation. The reserve should cover the spread during a volatile period in an effort to cover the costs associated with widening of a bid-offer spread during adverse moves. A market risk reserve is not meant to cover losses. It is meant as a buffer to handle liquidity and slippage during adverse periods. Income from a portfolio would flow into the reserves when a position is initiated and reversed when a position is liquidated. Market risk reserves can be used for transparent markets as well as opaque markets. Finding a suitable bid-offer spread for opaque markets can be a challenge, which makes processing of this type of reserve very important. Determining if a reserve should be released is a process that needs to be determined by both a risk manager and a portfolio manager to make sure that a specific type of risks are bucketed in the correct manner. Some risks, for example, can be very misleading. Exotic option structures contain delta risk that might be able to be hedged. Given that the exotic option itself might not be able to be hedged in the marketplace, determining if the delta can be an access for a release of reserve is an important topic for discussion between portfolio and risk managers. Credit risk is the exposure to risk that a counterparty to a trade defaults and cannot pay their losses on a trade, which will erase your gains. In the corporate world, traders can hedge credit risk exposure to many counterparties by purchasing credit default swaps or shorting a company's bonds. In dealing with companies that do not have credit default swaps, a trader can set up a credit risk reserve that incorporates the cost of credit while the trade is on their books. Similar to a market risk reserve, a credit risk reserve can be eliminated when a position is liquidated. Credit risk reserves cannot be eliminated when a position is hedged with a separate counterparty, which differs from a market risk reserve. In fact, when positions are hedged with other counterparties, the credit risk exposure actually increases as opposed to decreasing. Operational risk reserves are reserves that are placed aside in case a system or operational meltdown occurs. This can occur with a natural disaster, as seen in Japan in March of 2011, or a man-made disaster, as seen in 2001 during 9/11. The inability to trade or manage risk is a reasonable assumption and should be taken into account when managing a portfolio as a business.